How much do you actually need to retire? A common rule of thumb in personal finance is the 25 to 30 times rule. Take your expected annual expense in retirement, multiply by 25 to 30. That gives an inflation-adjusted corpus that historically supports a 30-year retirement at a sustainable withdrawal rate. The exact multiple depends on your risk and longevity assumptions. Apply it. 50,000 per month means 6 lakh per year. Multiply by 30, that is 1.8 crore in today's money. But that is the corpus you need at the start of retirement, not today. If retirement is 20 years away and inflation runs at 6%, the actual rupee corpus you will need is around 5.7 crore. 2 reality checks. This is a simplified illustration, not your personal retirement plan. Real planning factors in dependents, healthcare costs, lifestyle inflation, and other income streams. A qualified planner builds the actual number for you. Online retirement calculators give a directional estimate but cannot replace individual advice. Educational content only. Retirement planning is highly personal. Consult a SEBI-registered investment advisor. A 1% expense ratio sounds small. The expense ratio is the fund house's annual fee for managing your money. It is expressed as a percentage of your total invested corpus. SEBI sets maximum limits, but actual ratios vary by fund category and scheme. You can find your fund's expense ratio in the scheme information document. The crucial detail is when this fee is charged. It is deducted daily from the scheme's assets before the NAV is calculated. So you never see a line item deduction. The NAV you see is already net of expenses. The fee is invisible but real. Run the numbers. Same investment, same gross return, different expense ratios. On a 10 lakh investment growing at 12% for 30 years, the corpus difference between 0.5 and 2% expense ratios runs into several lakh rupees. This is not because of fund manager skill, just the fee drag. Educational content only. Check your fund's expense ratio in the SID document. Not investment advice. Your fund advertises a CAGR. CAGR stands for Compound Annual Growth Rate. It assumes one investment at the start, one withdrawal at the end, and computes the equivalent annual rate between those 2 points. Useful for lump sum investments. Misleading for anything else. Real investors do SIPs. Multiple investments at different dates, sometimes withdrawals or pauses. Each cash flow has a different holding period. CAGR cannot represent this accurately. XIRR, the Excel function with the same name, handles this. You list every cash flow and its date. XIRR returns the single annualized rate that reconciles them all. That is your actual realized return. Most mutual fund apps in India now show XIRR alongside CAGR. Use that number for SIP performance review. Educational content only. Not investment advice. Past returns do not guarantee future results. Your fixed deposit might be losing money in real terms. Take a fixed deposit at 7% interest. If you are in the 30% tax slab, the interest is taxed at 30%. Your post-tax return drops to about 4.9%. That is the actual money in your hand. Now subtract inflation. If headline inflation is around 6%, your real purchasing power is shrinking. 4.9% minus 6% is a negative 1.1%. Your money grows on paper but buys less every year. This is not saying FDs are useless. They are safe, predictable, and ideal for emergency funds or short-term goals. But for long-term wealth building, ignoring inflation in your return calculation is a critical mistake. Educational content only. FD interest rates and tax rates are subject to change. Not personal financial advice.